that remains to be seen. Obviously, having a vaccine is absolutely good news, but the materialization of the economic impact of the good news may take some time and will not happen overnight. The vaccine is good news because it means that there is sort of light at the end of the tunnel, that we can provide our citizens with perspective again, that this will end at some point in time. That should, of course, boost consumer and producer confidence. It should lead to lower risk premia on financial markets, and that means that favorable financing conditions become more self-sustained and can be maintained with less policy stimulus. But as I said, these effects will not materialize overnight. The vaccine may be there, but rolling it out will be quite complicated if, for instance, this vaccine, as I understand, needs to be rolled out at -70, -80 degrees Celsius. So mass vaccination is really going to take a significant amount of time. And that means that the economic outlook for 2021 will continue to be bumpy for a long time until finally these sort of benign effects of the vaccine will become fully available.
So in other words, is it fair to say that even with this positive news for the world and for markets, it doesn't necessarily reduce the likelihood of a big package come December?
Well, that we will have to, of course, assess once we have more information on the economy. It's well known that in December we will have a new round of staff projections on the economy, and that these projections will, of course, have different factors woven into it. On the one hand, we've seen that in the third quarter, the rebound was actually more strongly than we anticipated. So that shows that once these restrictions are over, that demand is actually quite elastic. At the same time, it is clear that we're now in the second wave and that growth momentum will stall into the fourth quarter. We don't know how long that will take, but all these factors, and some of which are opposing, will have an impact on the outlook for 2021, both for growth and inflation. And once we have all that sort of on the table, then we can come to an assessment of the appropriate recalibration of our monetary policy instruments.
And just to pick up on that word, because it caught a lot of attention at the last meeting, ECB said that they're standing ready to recalibrate all instruments. Can I read into that you're also considering even potentially moving rates into even more negative territory? So interest rates are still one of those tools?
Well, we would not want to exclude any measure in going into December. In the old days, of course, monetary policy was much more one-dimensional. We just had interest rates and you either moved them up or down. So any announcement that sort of further easing was to come was very clear, would be a reduction in rates. Now we have a whole set of monetary policy instruments active, from forward guidance to negative rates to TLTROs and asset purchases. And recalibration means that we will have not only a look at the size of the stimulus, but clearly also at its composition. And the role that negative rates will play in that package will have to be assessed alongside the impact that other elements of the package will have. Recalibration means that we will take a holistic view, not only with respect to the size, but also the composition.
Now, one of the emergency responses that you rolled out this year was the PEP program. And there's one characteristic about the PEP program that doesn't apply to the normal asset purchase program, which is the flexibility. You've got a lot more flexibility and don't really have to adhere to the capital key. Do you think this is one feature that you could, in the future, think of applying to the asset purchase program, even once PEP is fully terminated?
Well, the effectiveness of our instruments is state dependent. And the PEP was launched at a time in which there was significant market turmoil and the reoccurrence of financial fragmentation. Spreads were widening and they threatened to derail the sort of homogeneous transmission of our monetary policies into the euro area. In such a circumstance, asset purchases are very effective. And they are even more effective the more flexible you can apply such asset purchases. So the flexibility in these circumstances has served us quite well. Today's circumstances, however, are different. today's circumstances are characterized by a restoration of calm on the markets. There is no big market turmoil anymore. Financing conditions, including bond spreads, are back at the levels where they were pre-corona. So today's situation is a different situation. And then we will have to come to an assessment again on what is the optimal composition of policy instruments in this specific situation that we're facing today.